Finance can seem intimidating, but it's really about managing your money wisely. It's about making your money work for you, not the other way around. Investing is a key part of this. It's how you make your money grow over time. Think of it as planting seeds for a future harvest. Before you start investing, you need to grasp some basic terms. Assets are things you own that have value, like your house, car, or savings. Liabilities are what you owe, like loans or credit card debt. Your net worth is the difference between your assets and liabilities. It's a snapshot of your financial health. Investing involves buying assets that you believe will increase in value over time. These assets could be stocks, bonds, real estate, or even a small business. Each investment carries a different level of risk. Risk refers to the possibility of losing some or all of your investment. Remember, investing isn't about getting rich quick. It's a long-term game that requires patience, discipline, and a solid understanding of your financial goals. Whether you're saving for retirement, a down payment on a house, or your child's education, investing can help you reach your goals faster. There are many different ways to invest your money, each with its own set of risks and potential rewards. Stocks or shares of a company offer the potential for high returns but also carry higher risk. When you buy stock, you're essentially buying a small piece of ownership in that company. If the company performs well, the value of your stock goes up. Bonds are like loans you give to a government or corporation. They offer lower returns than stocks, but are generally considered less risky. When you buy a bond, you're lending money for a fixed period and receive interest payments in return. At the end of the bond term, you get your principal back. Real estate is another popular investment avenue. It involves buying, managing, and selling properties for profit. Real estate can provide rental income and potential appreciation in value, but can also be illiquid and require significant capital. It's crucial to research and understand the local market before investing in real estate. Mutual funds provide a way to diversify your investments easily. They pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds are managed by professional fund managers, which can be beneficial for beginner investors. Not all investors are the same. Some are comfortable with high risks, while others prefer a more conservative approach. Your risk tolerance, or how much risk you're willing to take on, is a crucial factor in shaping your investment strategy. If you're young and have a longer time horizon, you may be more comfortable with riskier investments. You have more time to recover from potential losses and can take advantage of long-term growth opportunities. As you get closer to retirement, you may want to shift to a more conservative portfolio. Your investment goals also play a role in determining your risk tolerance. If you're investing for a short-term goal like a down payment on a house in a few years, you may want to stick with lower-risk investments. For long-term goals like retirement, you can afford to take on more risk. Remember, there's no right or wrong answer when it comes to risk tolerance. It's a personal decision based on your individual circumstances, financial situation, and investment goals. It's important to find a balance between risk and reward that you're comfortable with. When it comes to investing in stocks, there are two primary approaches: value investing and growth investing. Value investors look for undervalued companies with strong fundamentals, but whose stock prices are trading below their intrinsic value. They believe these stocks have the potential to rebound and generate significant returns. Growth investors, on the other hand, focus on companies with high growth potential. They're less concerned about current valuations and more interested in companies with strong earnings growth, innovative products or services, and a competitive edge in their respective markets. Value investing often involves thorough research and analysis of a company's financial statements, management team, and industry dynamics. Growth investing, while also requiring research, tends to focus more on a company's future prospects and potential to disrupt existing markets. Both value investing and growth investing have their own merits and drawbacks. Value investing can offer the potential for significant returns, but requires patience and the ability to identify undervalued companies. Growth investing can lead to substantial gains, but also carries higher risk as high-growth companies can be more volatile. One of the golden rules of investing is diversification. This means spreading your money across different asset classes, industries, and geographical regions. Diversification is your best defense against market volatility. It helps reduce the impact of any single investment on your overall portfolio. Imagine you invest all your money in a single stock. If that company experiences a downturn, your entire portfolio takes a hit. However, if you have a diversified portfolio, the impact of a single stock's performance is minimized. When building a diversified portfolio, consider including a mix of stocks, bonds, real estate, and possibly other asset classes like commodities or precious metals. Within each asset class, diversify further by investing in different industries and geographies. The right asset allocation, or the percentage of your portfolio allocated to each asset class, depends on your risk tolerance, investment goals, and time horizon. A financial advisor can help you determine an appropriate asset allocation based on your individual needs. Compounding is the snowball effect of earning returns on your initial investment, plus any accumulated interest or dividends. It's like earning interest on your interest. The longer your money is invested, the more powerful the effect of compounding becomes. Let's say you invest $1,000 and earn an annual return of 7%. After the first year, you'll have $1,070. In the second year, you earn 7% on $1,070, not just your initial $1,000. Over time, even small differences in returns can lead to significant differences in your overall wealth. Compounding works best with long-term investments. The earlier you start investing, the more time your money has to grow. Even small contributions made consistently over time can make a big difference in the long run. Consider this. A 25-year-old who invests $100 a month at a 7% annual return will have over $1 million by age 65. A 35-year-old would need to invest almost twice as much each month to reach the same goal. Time is your greatest ally when it comes to investing. While investing is crucial for building wealth, it's equally important to manage debt effectively. Debt, especially high-interest debt like credit card debt, can be a major obstacle to achieving your financial goals. High-interest debt eats into your income, leaving you with less money to save and invest. It's like trying to run a race with a heavy backpack. Before you can truly start building wealth, you need to get your debt under control. Start by creating a budget and identifying areas where you can cut back on expenses. Then, prioritize paying down high-interest debt first. Consider debt consolidation loans or balance transfers to lower your interest rates. Remember, managing debt is not just about eliminating current debt. It's also about making smart financial decisions that prevent you from accumulating unnecessary debt in the future. Avoid impulse purchases and live within your means. Budgeting is the cornerstone of sound financial management. It's about understanding where your money is going and making conscious decisions about how you spend and save. Without a budget, it's easy to overspend and derail your financial goals. Start by tracking your income and expenses for a few months. This will give you a clear picture of your spending habits and identify areas where you can cut back. There are many budgeting apps and tools available to help you track your finances effortlessly. Once you have a good understanding of your cash flow, create a realistic budget that aligns with your financial goals. Allocate money for essential expenses like housing, food, and transportation, and set aside a portion for savings and investments. Remember, budgeting is not about depriving yourself. It's about being mindful of your spending and making choices that align with your priorities. It's about having a plan for your money so you can achieve your financial goals faster. The world of finance is constantly evolving. New investment products emerge, market conditions change, and economic landscapes shift. Staying informed is crucial for making smart investment decisions. Make it a habit to read financial news, books, and reputable online resources. Follow industry experts and analysts to gain insights into market trends and investment strategies. Attend webinars and seminars to expand your financial knowledge. Be wary of get-rich-quick schemes and promises of unrealistic returns. Remember, if it sounds too good to be true, it probably is. Investing is a marathon, not a sprint. Focus on building a solid foundation of financial literacy. Don't be afraid to ask questions and seek clarification if you don't understand something. Financial jargon can be confusing, but there are plenty of resources available to help you decipher the complexities. While you can certainly manage your own finances and investments, there are times when seeking professional advice can be beneficial. A financial advisor can provide personalized guidance based on your individual circumstances and goals. If you're new to investing, overwhelmed by the process, or have complex financial needs, A financial advisor can help you navigate the complexities of the financial world. They can help you create a financial plan, choose appropriate investments, and manage your portfolio. Financial advisors can also provide valuable insights during major life events, such as marriage, divorce, the birth of a child, or retirement. They can help you adjust your financial plan and investment strategy to align with your changing needs and goals. When choosing a financial advisor, look for someone who is trustworthy, experienced, and acts in your best interests. Ask about their fees, qualifications, and investment philosophy to ensure they align with your values and goals. Investing is not a get-rich-quick scheme. It's a long-term game that requires patience, discipline, and a commitment to your financial goals. There will be ups and downs in the market, but it's crucial to stay the course and resist the urge to make emotional decisions. Avoid panic selling when the market takes a dip. Remember, market fluctuations are normal. Instead of trying to time the market, focus on your long-term goals and stick to your investment strategy. Discipline is equally important. Make it a habit to invest regularly, even if it's just a small amount. Consider setting up automatic contributions to your investment accounts to make saving effortless. Remember, the most significant factor in your investment success is not market timing or picking the next hot stock. It's about having a solid plan, staying disciplined, and letting the power of compounding work its magic over time.